This is Tom Ashby with the Viper Report. In today's video, I'll discuss what the market looked like heading into the CPI report. It's been a tough year for many, as a lot have been out of stocks over fears of recessions, higher interest rates, etc. I teach about technical analysis. I was a successful biochemistry teacher and researcher before I switched to the financial markets. If you go to the Viper Report YouTube channel, you can see a bunch of my videos. They'll teach you some things that you were not aware of. For example, did you know that the stock market was dominated by value stocks from 2003 to 2007? I'm sure you know it's been dominated by growth stocks since then. But I'll show you how you can pick out who the leaders are. That was instrumental to the start of 2023 in getting us in the QQQ and many of the technology stuff. Some of you may be kicking yourself for not having a larger commitment of stocks heading into the CPI report, as the S&P and overall market indicators have soared. That was not surprising. Here are our positions heading into this CPI report for both traders and investors. Have some nice open profits. After last week's video, Monday's action convinced me to add retail, metals and mining, oil, small caps, and a highly leveraged SPXL, which is a 3-time leverage stock. You can see they already have nice gains in just the last couple of days. I feel confident I can teach you about the markets. If you go to the Viper Report, you'll see a lot of my articles, which have also been published on Forbes. And if you click on this, you'll see there's a special offer for traders and investors. Having taught both large groups and individuals around the world, I think one-on-one training is the best, because I'll ask you questions and I'll require that you look at the charts and you share your analysis with me so I can help you improve. That's the whole point. If you're going to have the confidence to act in the markets, you need to be convinced of the methodology. Too many people buy video packages or online courses, but rarely watch them and rarely are tested on what they've learned or not learned. Not learning is often the problem. This approach is carried out through PayPal. Essentially, once you pay $199 up front, we'll set up a phone call with me and we'll figure out a plan for your 90-minute course. If after that phone call you decide, hey, this is not for me, or if I decide it's probably not a good fit for you, which I've done a number of times, we just refund your money and that'll be fine. I've been very bullish in the stock market since the start of the year, and this week's action has really supported and confirmed that view. By learning about the markets, you'll be able to understand this chart of my advanced decline line analysis. It was sent out Tuesday morning before the open. Saw very bullish things happening as of the seminar that will follow. Wasn't quite clear with last Friday's close, but it became clear after Monday's action, and that's where we recommended the small cap ETF for both traders and investors, as well as this triple leveraged ETF. These are the methods that help me pick these various ETFs for my clients. Stock traders can also use the same methods. These are our stock portfolio from the Viper Hot Stock Service. Tuesday morning, we recommended Royal Gold. It's already up over 4% in just 2 days of trading. Of course, past performance is no guarantee, but I've been doing this with a great reputation for decades. So let's get to the video. As always, if you have any questions or comments, you can email me at tom@viperreport.com. Thank you. This is kind of one of the basic screens that I actually set up for one of my teaching clients, and you must be familiar with this. So the Spider Trust, interesting close. We'll look at an hourly chart here, but that was not a great close. Volume was a little heavy on this decline. So the main question is this little pause just a pause after the long breakout? That's sort of my favorite scenario, and I'd be more confident that if we hadn't closed so weak. But you can see once again the S&P 500 AD line made a new high here, another new high. This is just a normal pullback. When we got this little pullback here, we recommended the QQQ for a trade, with the understanding that the more broadly based stocks only still looks much weaker. It finally made it above this peak, but well below the February high. Stock and the NYSE all is acting much better, and they've all turned up from their moving averages on Friday because the numbers for the day were positive. So that's an encouraging sign. So it'll be interesting to see what Sunday brings, to us. That'll be so. I have a couple questions. I'll do questions again in about 10 minutes. So let's go through this. So 20-day EMA, of course, 435.41, and the pivot 434.28. So if you aren't using pivots, I mean, I think if you any message I'd get for the first half of 2023 is, follow the pivots, and also use relative performance. Look at those markets that are performing better than the S&P. You can see that the pivots acted pretty well for a good part. We moved just above it in May and then got a positive signal. We ran right up this level here is the R1, pulled back to the pivot, and that generated a very nice positive signal. Of course, the Qs have been leading, and so this is the NASDAQ 100 and the NASDAQ 100 advanced decline line. Some will be looking at double top here. Certainly that's positive. If you look at your chart analysis, you need to really drop below the intervening low to confirm the double top. So we're well, above that level. We're fractionally, in fact, the AD line closed right on its EMA 2861. So, it's neutral, I guess, at that point. So clearly, early on Monday, we'll get an idea of what that means. Once again, it's broken out of a major range. So the intermediate trend to me is still very positive. It's just a matter of whether we're going to get, see a pullback, into this S1 here, which is 14,504 or lower. You can see both the 20-day EMA in blue and the 50-day are rising sharply. So one of my students asked me, so what's the simplest way to cancel out, taking a position? I said, well, really a simplest way, if you see the 20-day EMA in that sort of decline, too early to buy, okay? And it's below the pivot, okay? That changes early in the next month. It's the moving average here is starting to turn higher, and it's back above the pivot. So some of the most basic things can save you a lot of time in your analysis, which is what I try to do with my students. I know it's pretty overwhelming. Let's look at some of the other average. The OEX used to be the darling of the option traders. I guess it's the top stock in the OEX. So it's looking a little toppier, okay? We have lower highs here in the RS. So, it was outperforming the S&P all the way through here. But, it's sort of flat with it now, okay? So that flatness, little divergence doesn't necessarily turn me negative. If we start to see a sharper decline, in other words, if it starts declining more than the S&P, that would be a negative sign. The OBV has formed a divergence because we had a new closing high here, not by much, 2081.07, 2081.16, I think, or 86. So a slight negative divergence, but that means that you could see an OBV drop back into that support level. Small caps, I've been watching those pretty closely. I think they're probably close to turning. So we have the S&P 600, is a little more selective, if you will, in terms of what's in it as opposed to the Russell. I think the Russell has a more iffy companies with sort of probably a worse balance sheet, etc. And the AD line, so this is the S&P 600 AD line, is trying to bottom here. So that looks kind of interesting. Had a sharp drop below the pivot and then held above the pivot here. And, in terms of trading, the IJR is the one that tracks the S&P 600. So you can see the OBV just flipped back above its moving average, on the close on Friday. And if you move above, this high at 100, you can get an easy move to 102.89, the R1, or the 106.14, the R2. So let's see what else we got down here. I've been including lots of charts. I don't know how many of you are subscribers or to either to the ETF service or not. I hope you find them informative and useful. I do a lot of horizontal, so that's why I've been including it. They've been very helpful for entry and exits, and particularly the whole rise here from the May low has acted pretty well. We had a nice breakout. We got up to the measured target was around 430 sideways there. We broke out above that after moving sideways. So you can look at these. This is the on-balance volume, which works actually pretty well in really liquid ETFs like SPY. From the 443 high, this was the minor support. You got down here to a stronger support, around 431 and back off to the upside. So you can see the week close here. Volume was heavy. On a Friday, a 1-bar volume may or may not be significant. It could be a number of reasons. So, but clearly the support here, the 437 area, down to, 431. If we're going to see this market turn around to the upside, those are the areas I expect to hold. Works even better on the QQQ, or it has recently, for a lot of our entry positions here. Once again, we're at the breakout, at 325, pull back here, held just above that level. 357 came down into 347, which was, this is in the late May, early June. Sharp new high, 272, and then pulled back nicely into that 257, where we got a long position. We were stopped out last week because that pushed it up pretty tight. Thought that if we dropped much below 262, we go back to that 257. So but it's once you learn, if you look positions, a lot of people have been thanking me for how helpful it's been. One of the standard indicators in terms of, and I had a couple questions. We'll deal with these in a second. For the market short-term trend is the advanced decline. Excuse me. This is the advanced minus decline oscillator, a 5-period exponential. So it just shows you imbalances. So it gets around here, minus 600 lately has been a low, whereas up plus 800 to up to plus 1200, that's been a peak. So, if you're looking at this and you see, it's up near that upper range, and you think about establishing a new long position, it kind of tells you, well, you might want to wait a little bit. We've seen some major, this low back here, was historic. If we look at the breakdown of the chart, you can say, well, let's go back, pick a number of years, 4 years. You can see it's, got down to minus 1800 last October. That was even worse than the COVID low. Tell you how oversold it was. So we're down there a few times though. But anyway, it just gives you sort of an overall read on the market. Another way you get that kind of overall read is by looking at the stocks above and below a moving average. So Stock Charts does a really nice job allowing you to look at different ones. So what do we have? We have SPX, and we have here, we have the stocks in the S&P above the 20-day moving average. So it's a really pretty sensitive one. So, you get down here in the 20 to 30 range, that's usually where corrections end. You got a little deeper one here in March, But in the end of December, we were back down here in the 20. October, we were even almost down to zero. So why is this important? So, some technicians use this breadth indicator pretty much the opposite of the way I do. They look at it like, oh man, this is so low, the market's really weak. I look at it as being, well, there are very few positive stocks here. So the odds of a rally are increasing because the rubber band is stretched on the downside or stretched on the upside. You can see this one formed some pretty nice divergences here. So at the February highs, we saw signs that the rally was run out of steam. Its decline was all value. Growth stocks held up pretty well, but the value got hit. We broke the uptrend right back down here. Also, again, in April and May, got sideways action here. And now currently, we have higher highs in the SPX, lower highs, in the number of stocks above the 20 days. So we peaked out above 80%. Sure, I mean, we get a further correction that could easily pull down into the 35 to 40% range. No divergences here in the 50 day. So in red here, the 50 day. Other times we've seen some divergences here, here a little bit, and quite a bit in, once again, the February, March slide. But the fact that it's made higher highs to me suggests it's a pullback, not necessarily a major top. And below here, we have the 200 day. Some people just turned positive on the overall breadth if you get this above 50. So they were turning positive in June saying, breadth is signaled higher. Well, that's a little late to me. I mean, you're much better doing it when the last, the wide breadth thrust signal occurred back in March. So much more reliable. So here we have the NYSE composite, the new high, new low analysis. If you aren't familiar with this, there's an article on the website on Viper Report about it was a warning of a top in late 21 because it particularly bases the NASDAQ. So you want to see sort of a generally positive trend, in the rising new highs when the market's turning higher. And conversely, you want to see, a bottom formed. You want to see, the maximum new lows were here. We got a retest of the low. There were fewer new lows. So that means that's a bullish setup. May take a little bit for you to wrap your arms around it, but essentially, fewer stocks were making new lows. So that's a positive sign. If this had been up here higher than this peak, that would say there's quite a bit of selling pressure. Similar here, we saw, in June, before the really nice rally, and we got back down to that low in July. There were positive technical signs, so we did a pretty good job of catching that rally, and you can see that was supported by the high-low analysis. So right now, we had a sharp surge in the NYSE, new highs, dropped off to the end of the week, from 225.54. I saw some analysts saying, oh, well, that's negative. It's a little surprising it would drop that fast, but too early for me to say that's negative. In the article, I discussed what I look for. You can see the new lows are still pretty, a small number. Okay. So you wouldn't want to see them move above this line D and probably this one, which I think is about 230. You get more than that, that means increase in selling pressure, which would be more consistent with a deeper decline. So far, we don't see that. A little more negative in the NASDAQ composite. You can see a clear negative divergence here. We had a new closing high, and the NASDAQ composite wasn't confirmed by the number of new highs. And once again, we have a resistance level here, right around 260, I think, in the NASDAQ new lows. And those of you who are interested, let's see what the exact high. So if you want to find out what that actual number is, so here we have that. This is the new lows symbol right in here. This is one of the many things I do with some of my students I work with. I show the ins and outs. So we'll look at this signal here, the number of new lows. Okay, that doesn't help you a lot. But then if you look down here where you have past data, all right, so you can see what the past peak was. Looks like it's 202. It's right in here. So this gives you the lowest readings back in, well, Thursday, 476. So that was, let's back this up. So, so that was, yeah. So this is 476 right up here. Interesting to look to be that May. Oh, here. So that's the 476. So that peak in the latter part of May 202. Yeah, and that'll allow you to do that. So stocks above, somebody just asked me if you get stocks above the 20-day in the free version. I don't know that question. I mean, you can see that the symbol. I've been putting a lot more links in the publications so you can get some of these charts, and some of the setups. So we can investigate that in a second. But you can look at I'll give you the symbol, or, any follow-up questions, of course, you can email me at tom@Viper Report. So what about the growth value? Been a real winner for us because, we really favored the growth components. There've been IWF periodically and QQQ. So it's interesting. It was totally flat. Okay, remember a review that not a lot of people look at this. So this is the ratio of IWF, that's the Russell 1000 growth, to the IWD, which is the Russell 1000 value. So when it's falling, value is leading. When it's rising, growth is outperforming. So you can see right from, all the value stocks were outperforming the growth stocks. So we got down into the end of the year. Of course, that's when the RS analysis turned positive on the Qs and started this uptrend. So I've been looking for this trend to change. Too early to say it has, but what you see here is the MACD's histogram has started to diverge. If you look back on this chart, I mean, there are lots of examples of what a good signal this was. So back in 21, lower lows in the ratio, higher lows in the MACD. Back in the end of 21, as growth was peaking out here, a strong divergence there. And then a combination of positive divergences. This was the rally off the July lows, right up in here to resistance. And so looks like it's going to be trying to churn. If you look at a daily chart of that, really too early to say it has. But see, it looks like it's sort of a rising wedge here in the ratio. So, I'll be looking for a drop below this 1.272 or 1.696. If you break those levels, that would confirm the action of the MACDs, which are both negative. So that's one of the reasons I started getting into IWD, already long IWF, because I thought that was likely. Thought this was interesting setup, and if you're a subscriber, shoot me if you want to see this one. I'll be glad to share it with you. All my students that I teach, I send them all my chart setups, so they don't have to go. I show them how to create them, but I also provide them because it makes it, saves them time, and time is valuable. So this is a different sort of relative performance analysis. I've talked a lot about the weight of the evidence. And one of the reasons why my students, I have them do lots of charts on their own. So I send them a list of charts, analyze me, tell me what this market's going to do. Then I grade them the next time around and try to improve them. And usually, I mean, people who watch the markets, work with a couple of sort of financial professionals who, are picking it up really quickly. But I noticed this on advanced micro devices. They've been gangbusters. So this first one is the relative performance of AMD versus the VTI, the Vanguard Total Stock Market. So you can see it was peaking up here, higher highs in the AMD, lower highs when compared to the VTI. Down here we have the technology, the XLK. It was also diverging from the XLK, and then the semiconductor stocks, even a stronger divergence, and then a top warned of this drop from, I guess we went from 132 down to 107 so far in AMD, and it was a really good warning. So it just tells you that, if you think AMD is topping out, you can look at different ways to confirm that. Also, it has markets have often some very orderly, sort of opinions. So it went from 54 to 79, so that's 25 points up. From 60 here, it went to 88, so that was 28 points up. From 75, it went to 102, 27 points up. So really, the rhythmic nature, and you can see the OBV didn't give you any divergence at that high, but it did, drop below its moving average early in the decline, and it's still negative in here. So, I'll be watching in AMD, for it to get back into that level, into that support, that I think might be significant. Okay, let's handle some of the questions here since they're piling up. Nice breakout. Tom was wondering about your thoughts on the weekly NYSE AD line. Okay, lines here are not in the quite right position, but it is positive, but it's lagging like the NYSE is wide a ways below its high. So, some perma bears, use that as a reason to do that. So, it looks like a nice breakout recently above the descending trend line in October. Okay, yeah. So here, this is what the downtrend he's talking about. Usually, those who've taken the advanced decline course will kind of say like, yeah, these longer term trends are important. So right now, this was a significant at the start of the year. It's not, what this means here, is the fact that, like everyone's been telling you, it's been a narrowly focused rally. Does that mean it's necessarily not going to spread to the other markets? No. There's one of the reasons so many professionals were on the wrong side of the market for a good part of this year was the fact that they thought an inverted yield curve had them in a recession. Well, they could be right. Recession the end of this year, next year, 25, but what you don't know is the lag type. And when everyone's counting on one thing to be true, usually not a good sign. So we broke this. I wouldn't want to see, the first warning sign be a break below this low in May, and then that March low be more significant. So, it's still got, resistance right around in here, but, and the S&P obviously has been the highest. You have that just, much stronger than the other. So, and the breakout of this formation. So, and look again, the 20-week EMA. So, it asked me about that. Look how well it worked all the way up through, the 21 high here, and pretty much through the bear market. We got sideways here in August, but, it's clearly in a positive trend. So that means that, okay, before you see a real top, you're going to have to see this drop back into here and probably rally. So it needs time. If we get a pullback to that right now, the odds will suggest it's a correction in an ongoing uptrend. If you have a buy signal, do you recommend going long before earnings or waiting? I normally don't mess around with earnings. I've had a couple of stock trades. One, that worked out really well, Federal Express, because it got hammered in after hours, and then never traded below our, I canceled the stop before the New York open. So, we're still in it, and it still looks pretty good. Another one was just, nailed right through my stop, gapped about 3% below it. So basically, when I was starting out and changing from being a biochemist, I looked at fundamental, I looked at technical analysis. Even back then, I thought the fundamental analysis was too iffy. Technical is based on the real data. They're based on, somebody is out there who's willing to buy or sell a stock or commodity for that matter at a certain price. And in terms of earnings forecasts, and then that's one variable that's really hard to say that it's accurate. And then secondly, how's the market going to react? Well, we've seen any number of examples where, earnings were worse than expected and the stock was up. The earnings were much better than expected and the stock went down. I mean, if you look at a long-term chart of Amazon, and you go back for, ever, let's see, they had earnings. Maybe it was here, right up. I remember they moved up. I think it was right. I think it was in the first quarter of 21, spiked to a new high on their earnings and never exceeded that high. Well, close, about 2 months later. But, that's why I really got to look at the relative performance. Based on that, it's still probably not being Amazon. This declining, conversely, if you put in something like, QQQ, it turned negative, and, it topped out and in 2021, 22, and then turned back around. So you broke that downtrend. But in 2018, 2019, it was still really positive. So the relative performance, I think, is something, so no, I usually don't take a position in front of it. If I have a nice profit, in a stock, I may hold it through. If I haven't kept data on it, but probably I've regretted it more often than not. So, stock charts, and of course they've added a lot more features. So I mean, you could get lost forever, but this performance thing is pretty nice. So this is now giving the relative performance of the 11 sectors to the SPX. So one day, so this tells you what Friday. 5 days gives you a weekly. I think that's a little more significant. So, XLRE, real estate, despite the worries about, commercial real estate, it's acting better. 1 month, that's kind of the way I really look at it. So XLY, is still acting pretty good. You can see that, only, 5 out of 11 are outperforming, or 4 out of 11 are outperforming SPY. So that's something, I'm looking at, if you look at XLE, it's, down 11% in the 3-month performance. So that's one of the interesting, things that I follow, and it's one that I follow, every day. At the end of the day, part of my routine is to look at that. Oh, most of you know so this is a list of weekly doji buy and sell signals that I haven't vetted yet, but maybe I'll post them anyway. I go through them. So the weekly doji buys, weekly doji sells, they'll be publishing tomorrow after I look through them, but they have to have certain criteria before they really meet a correct doji buy or a doji sell. But pretty interesting. Some of the signals work great, and they can be really handy if you look into those and follow them, some of the major turns. And last thing I think I want to show you here, let's see, is so build a routine. That's what I recommend people do. Similar to the ones I just showed you. That's kind of a part of one I created for a client. And get into a regular and look at the markets. You can see how, this is the ITB versus the SPX. So a market leader in April dragged down that correction. So it's very strong here. Now it's right down to support to IDP. So, and most of the housing stocks and Linear, for example, which we're are in this. So, okay, pullback or top. If we hadn't made new highs here, I would say, more of a deeper correction. But you can see we're right into the pivot. We're right into the 20-day EMA. So that'll be interesting for Monday's trading. So great. Please send me your comments. I will create a a tape of this and put it up for you want to watch it. And if you don't want to have, if you want to ask me questions offline, I can understand that. And once again, Tom at viperreport.com, and send me things I should have covered in my market coverage. So hope you have a great weekend, and hope you got. If you're not a client, a subscriber, but you would like to see that ETF table, just put ETF table in the subject line, either to me or to Wentworth Research, and we'll send you off a complimentary copy. Well, thanks to I don't know if Jerry and Scott are still there, but thanks again, guys, for all your hard work. And if you ever need anyone to, create, help you with Excel, he's the guy. So I like this review. I hired for 2 scripts already within the past few weeks. Did everything exactly what I wanted. Very, very nice and amazing. So I will end on that. Oh, he is amazing. So thank you all for tuning in.